Is Newmont Mining the hidden treasure that savvy investors are overlooking? With projections of its intrinsic share value soaring to over $100 and robust free cash flow, could this be the golden opportunity amidst industry challenges like inflation and debt? Join us as we uncover the potential within Newmont's financials. Ready? Let's roll! Founded in 1916 and headquartered in Denver, Colorado, Newmont Corporation is a leading gold producer with operations across the Americas, Australia, and Ghana, holding 92.8 million ounces of proven and probable gold reserves, which are economically mineable. Along with 62800 square kilometers of land, it has a robust asset base. Diversification into copper, silver, zinc, and lead offers potential hedges against gold price volatility and access to multiple commodity markets. As of September 30th, 2024, Newmont Mining increased its cash reserves to $3.016 billion, boosting liquidity to navigate uncertain markets. Long-term debt slightly decreased to $9.099 billion, reflecting cautious borrowing. The debt-to-equity ratio improved to 0.30, indicating low reliance on debt financing. A ratio below 1 is generally favorable and suggests financial stability. However, negative retained earnings of $2.101 billion signal accumulated losses over time, which could be a concern. Overall, the company's enhanced cash position and prudent debt management position it favorably for future investment opportunities, while highlighting the need to address profitability issues. Here's a screenshot of the full balance sheet. Notably, Newmont's asset base shows strategic reductions in stockpiles, aligning with efficient resource management. The decrease in accounts payable suggests improved cash flow control, yet maintaining this trajectory will be crucial for sustaining long-term financial health. Newmont ranks in the top 1% for preferred stock, showcasing balance sheet strength. However, its cash minus debt is weak, better than only 1.3% of industry peers, indicating liquidity concerns. Retained earnings and debt to equity offer a mixed outlook. Newmont's gross margin dipped slightly to 31.66% due to inflation in raw material costs. Gross margin measures profit after production costs, so this decline suggests increased production expenses. However, operating income margin remained robust at 28.19%, reflecting effective management of overall operating costs. Net income margin improved to 20.02%, indicating enhanced profitability after all expenses and taxes, a positive sign. Although EPS growth was flat, management's focus on innovation may drive future earnings. Maintaining strong margins in a challenging economy demonstrates resilience, crucial for value investors assessing long-term potential. Here's a screenshot of the full income statement. Notice the year-over-year increase in net income from $163 million to $924 million for the quarter, signaling potential growth. However, fluctuations in foreign currency adjustments could impact future profitability. Evaluating these factors is crucial for assessing Newmont's investment value. Newmont's strong EPS growth surpasses 88.7% of industry peers and 92% of the S&P 500, indicating robust earnings expansion. Efficient SG&A management places it above 80% in both comparisons. However, net and operating margins lag within the industry, suggesting room for operational improvement. Newmont Mining's revenue climbed steadily to $4.61 billion by September 2024, signaling strong demand. Importantly, net income rebounded from a $3.15 billion loss to a $922 million profit, highlighting effective cost management. Stabilized net income margins, net income as a percentage of revenue, reflect financial stability. The company's focus on market penetration and efficiency positions it to capitalize on future opportunities, a positive sign for value investors eyeing sustainable growth. Newmont Mining Corporation's free cash flow rose to $771 million as of September 30th, 2024, up from $594 million in the previous quarter. This improvement reflects enhanced operational efficiency and better working capital management. A free cash flow yield of 1.73% means the company generates significant cash relative to its market capitalization, indicating efficient cash generation. The capex margin at 12% suggests substantial reinvestment into technology upgrades, which could drive future growth. These ongoing investments in capacity expansion may strengthen the company's market position and support sustained profitability. Here's a screenshot of the full cash flow statement. Newmont's robust net income at $1.96 billion underpins strong cash reserves despite high capex levels. However, hefty debt repayment poses a risk, highlighting the need for cautious financial management. Efficient asset sales are crucial for maintaining liquidity. Newmont excels in free cash flow yield, outperforming nearly 79% of its industry and 70% of the S&P 500, indicating strong cash generation. However, its capex margin scores poorly, suggesting higher capital expenditures relative to revenue, which may impact profitability. Analysts forecast Newmont's net income to increase to $3.56 billion by 2028, reflecting confidence in its strategic initiatives. The expected rise in earnings per share to $4.23 indicates improved profitability for shareholders. This positive trend suggests that the company's focus on innovation and market resilience may drive sustainable growth. Comparing these projections with industry peers can provide deeper insight into Newmont's valuation and investment potential. Newmont's recent earnings call highlighted both opportunities and challenges. They produced 1.7 million ounces of gold in quarter 3 and expect an 8% increase in quarter 4. However, they're reducing 2025 production guidance by 350,000 ounces due to issues at key mines like Lihir and Brucejack. The sale of non-core assets could bring in up to $1.5 billion, improving focus on core operations. They've also authorized a $2 billion share buyback, which can enhance shareholder value by reducing outstanding shares. Yet increasing sustaining capital costs and inflation, particularly in labor, remain concerns. For investors, the key is how these factors will affect long-term profitability and margins. Newmont's net income and EPS scores are below industry average, around the 40th percentile among peers, and significantly underperform the S&P 500, falling in the bottom 13%. This indicates profitability concerns compared to both its industry and the broader market. Newmont's negative PE ratio of minus 13.81 indicates recent losses, but is less severe than Pan American Silver's minus 51.42. A PB ratio around 1 like Newmont's 1.2 suggests the stock is trading close to its book value, potentially pointing to undervaluation compared to competitors like Wheaton, Precious Metals with a PB of 3.21. Management believes strong cash flows and market leadership aren't fully priced in. With strategic product differentiation, there's potential for valuation multiples to improve, offering opportunities for value investors seeking long-term gains. Per our proprietary Bow score, Newmont's PE ratio ranks lowest among peers in the market, signaling earnings concerns. However, its strong PB ratio suggests the stock is undervalued relative to its assets, potentially making it attractive to value investors. Discounted cash flow analysis suggests Newmont Mining's intrinsic value per share could reach about $103.95 by 2028. This reflects robust revenue growth and a stable weighted average cost of capital at 6.13%, balancing financing costs. Management expects increasing operating cash flows, forecasting free cash flow of $2.35 billion, supporting aggressive investments in technology and capacity. The current market price doesn't fully capture this intrinsic value, indicating potential upside if operational efficiencies and strategic initiatives enhance financial performance. Newmont's exceptional DCF score indicates it's significantly undervalued compared to industry peers and the S&P 500. This strong valuation metric highlights potential for appreciation, suggesting Newmont is an attractive prospect for investors seeking undervalued opportunities in the mining sector. Analysts expect Newmont stock to average $57.86 in the next 12 months, with potential highs of $63. This favorable forecast reflects management's strategic initiatives and market expansion. Considering past peaks like $72.07 in 2022, the projections suggest the company's resilience and possible opportunities for investors. Our proprietary Bow score for analyst targets indicates that Newmont surpasses 75% of its industry peers and outperforms 95% of the S&P 500 companies. This strong analyst confidence highlights significant upside potential relative to both its industry and the broader market. Newmont Mining's vast gold reserves and diversified assets underscore its foundational strength. While negative retained earnings and production setbacks raise concerns, the company's improved cash reserves, strong free cash flow, and robust EPS growth highlight financial resilience. Its PB ratio near 1.2 suggests undervaluation relative to assets, and DCF analysis points to significant intrinsic value upside. Analyst forecasts of rising net income and share prices further indicate potential growth. For value investors, these factors suggest that Newmont stock may indeed be an overlooked opportunity, warranting careful consideration amidst operational risks and profitability challenges in the mining sector. Make sure to watch another video from our Value Explorers series by clicking the playlist below.